Good day, ladies and gentlemen, and welcome to the Foley and Lardner Employee Benefit Broadcast. During today's call, all lines will be in a listen-only mode. If you require operator assistance at any point during today's call, please press star then 0 on your touch-tone phone. As a reminder, today's call is being recorded. At this time, I would now like to turn the conference over to your host, Ms. Kathy Azawa. Sir, ma'am, you may begin.
Hi, thank you very much. And thank you, everybody, for joining us today. Before we get started, I just want to quickly go through some housekeeping issues. If you need any technical assistance during today's program, just dial 866-493-2825. And if you have questions that you'd like to pose to the speakers, you can post your question by clicking on the Q&A at the top of your screen and typing your question. Also, if you would like to maximize your PowerPoint so it fills up your screen, you just hit F5 on your keyboard. And if you would like to print a copy of this presentation, you just click on the printer icon in your lower right-hand corner and then print as usual. So today we have a pretty full agenda, and we're starting off with headline news by Belinda Morgan, who is a senior counsel in our Chicago office. And she's going to talk about the health care reform legal challenges lately, and also the delayed effective date for the insured plans non-discrimination rules. I'm then going to provide a Cram session on the Form 5500 Schedule C reporting requirements, which have been really beefed up by the Department of Labor. Next will be Chris Berry, who is a partner in our Madison, Wisconsin office, and he's going to be talking about the new definition of who is a fiduciary. And then in the spotlight, we'll feature Galen Mason, who is a senior counsel in our Chicago office, and he's going to talk about the new plan and service provider fee disclosure regulations that just recently came out. So with that, I'm going to turn it over to Belinda.
Thank you, Kathy. Today I'm actually going to sort of switch up my order of this presentation. I'm going to speak about the delayed effective date for the application of Code Section 105H and its non-discrimination rules to fully insured health plans. As many of you probably already know, the Code Section 105H non-discrimination rules have historically been applied to self-insured plans only, while fully insured plans were generally exempt from those requirements. And that allowed plan sponsors to use fully insured plans for a variety of different purposes that might have otherwise been prohibited with respect to self-insured plans, such as providing continuing health benefits for certain groups of retiree employees but not others, or for potentially providing more generous health care benefits to highly compensated employees and so forth. With the enactment of the Patient Protection and Affordable Care Act, or PPACA, that basically changed. PPACA applies the Code Section 105H rules to fully insured plans now, and so things are much different. In order to basically understand how this impact will affect, how the new requirements will affect fully insured plans, it's necessary to understand how the basics of Code Section 105H as it currently applies to self-insured plans will work. And in that respect, with respect to the self-insured plans, 105H basically establishes criteria for determining when those plans will be treated as discriminating in favor of highly compensated individuals. And for this purpose, a highly compensated individual is someone who is in the top 25% of all, in terms of pay, of all employees, the 5 highest paid officers, and shareholders who own more than 10% of the value of an employer's stock. Now, this is somewhat different than your normal definition for highly compensated employees under the code, which generally is keyed to a certain amount of compensation. With respect to plans that are subject to 105H, those plans cannot discriminate in favor of highly compensated individuals, either with respect to eligibility to participate in the plan or with respect to the benefits that are provided under the plan. The tests for making that determination are very complex, and for this headline news segment, we really don't have enough time to get into them in any real detail. But just suffice it to say, there are very detailed regulations governing those requirements, and they've caused a lot of consternation for people who have to deal with them. If a self-insured plan is found to be discriminatory in one way or the other, then basically excess reimbursements that are paid to any highly compensated individuals are treated as taxable income to those individuals. And what constitutes an excess reimbursement for this purpose really depends on why the plan is discriminatory. If the plan is discriminating with respect to coverage in the sense that it's providing coverage to highly compensated individuals versus non-highly compensated, then a highly compensated individual's taxable excess reimbursement is a pro rata share of the amounts that are reimbursed to all HCIs. If the plan discriminates as to benefits provided, then the HCI's excess reimbursements are the amounts that are actually paid out for the benefit of that particular highly compensated individual. And as I mentioned, prior to the enactment of PPACA, these rules applied only to self-funded medical plans. With the advent of PPACA, however, now fully insured medical plans that are not grandfathered, I think that's a key thing to remember here, it's only non-grandfathered plans that these rules will apply to, must now apply the Code Section 105H non-discrimination rules using rules that are similar to those that are applicable to self-funded plans. This has really raised questions as to how exactly those rules would apply, given that the types of plans are so very different, they operate very differently. And in fact, the penalty for noncompliance with respect to those two different types of plans are very different. As I mentioned a moment ago, the penalty for noncompliance with a self-insured plan is inclusion of excess reimbursements in the income of the highly compensated individual. Well, with respect to a fully insured plan, it's somewhat different, and the impact is more on the plan. A discriminatory insured plan is subject to civil action by the non-highly compensated individuals to compel the provision of the same benefits that the highly compensated individuals are receiving. In addition, a plan sponsor could be subject to a $100 a day penalty for each person that has been discriminated against. So each non-highly compensated person for each day that the plan remains discriminatory. So it could be a very, very expensive proposition to be discriminatory with respect to a fully funded plan or a fully insured plan. Given all the concern over how these new rules will apply, and there were a lot of questions and comments issued to early guidance that the IRS had originally issued. Late December of last year, the IRS issued Notice 2011-1. That notice delays the application of the Code Section 105H non-discrimination rules to insured plans basically indefinitely until there is guidance that can really help plan sponsors be able to apply this information.
Thanks, Chris.
That
go over today.
information will basically with respect to I'm sorry, there's some noise on the line. Compliance with those non-discrimination rules isn't required until the further guidance is provided, and no sanctions will be applied to any plan sponsors who fail to comply. Any guidance that's issued with respect to these rules will be issued prospectively, so employers do have some time to comply with the requirements. In addition, another aspect of PPACA that has caused a lot of attention or garnered a lot of attention of late and has already caused a lot of litigation is the so-called individual mandate portion of PPACA. And that's the portion that requires pretty much all Americans to maintain a level of health care insurance at a minimum level effective as of January 1, 2011. Penalties are then imposed on persons who fail to obtain that coverage. The individual mandate has already become the subject, as well as PPACA as a whole, of a number of lawsuits. In fact, it's apparently more than 24 lawsuits have been filed across the country with respect to the individual mandate and other provisions of PPACA. One of the key arguments with respect to the individual mandate litigation is that the individual mandate exceeds Congress's authority under the Commerce Clause to regulate activities affecting interstate commerce. And the basis for this argument is that the decision to abstain from some sort of activity by not purchasing the required minimum coverage should not be treated as an activity that can be regulated under the Commerce Clause, and that Americans, simply by virtue of their citizenship, should not be treated as being a participant in commerce that can be regulated under the Commerce Clause. According to one of the courts that has reviewed these claims, this is really a case of first impression, because generally the Commerce Clause cases have dealt with issues that involve some sort of activity but not inactivity, as in this case. And as you probably expect, there are opponents and both proponents of PPACA. They disagree on the likelihood of the success in these cases. There are some other main challenges that have been raised with respect to the PPACA provisions, and that's that by revising the provisions of Medicaid, they basically coerce and commandeer the state's participation in the federal program, which violates the 10th Amendment and the Spending Clause. There are arguments that the penalty that's imposed on citizens who fail to purchase the required coverage is more or less an unconstitutional tax. And there are also claims such as freedom of religion claims, freedom of privacy, due process, and so forth. So far, there have been 4 federal district courts that have ruled on the merits of the Commerce Clause claims. 2 of the courts, one in Michigan and one in Virginia, have rejected the claims, finding that inactivity in this context with respect to the insurance market actually does constitute activity as part of the Commerce Clause because of the large effect of the persons not purchasing coverage under this requirement and how it all works into the overall scheme of PPACA and the coverage requirements under that. One of the courts has also noticed that the decision to pay for health care without insurance is really part of an economic activity which is subject to the Commerce Clause. 2 courts, one in Eastern District of Virginia and the other in the Northern District of Florida, have found that the individual mandate is unconstitutional. And while the Virginia court severed the individual mandate from the rest of PPACA, allowing the rest of PPACA to go forward and be implemented, the Northern court took that a little bit further, the Northern District of Florida court. It basically found that there are too many moving parts within PPACA, that the individual mandate was an integral part of the entire act. And so by finding that portion of it unconstitutional, it also found that it could not be otherwise severed from the rest of the act. And while the Florida court declined to enjoin the implementation of PPACA entirely, it did admonish the federal government that it should treat the ruling as such and to not go further. In that vein, more recently, the Virginia Attorney General has recently filed a motion with respect to the Eastern District of Virginia case, and that's the case that actually found the individual mandate unconstitutional but refused to strike down the entire law. It has asked the Supreme Court to review that case so that any uncertainty that's currently involved with the cases and the varying rulings that are going on right now can be resolved as quickly as possible, just because there's so much implementation that is required before 2014 for each of the states to deal with. They need to be able to have that time to either implement it if necessary or not. And given the costs, it's important to see if that will be able to be resolved as quickly as possible. While it's probably unlikely that the Supreme Court will take the case before it goes to the appellate appeal process, this is something that the Virginia Attorney General is attempting to do sooner than later. And as this moves forward, the White House still believes that PPACA will be upheld eventually, and so has continued to implement it and has suggested that states continue to do so as well. This is something that, given the uncertainty, employers and plan sponsors do need to keep in mind when they're looking at other provisions of PPACA that might affect them. Whether or not the entire act will be eventually struck down is really unclear. It's not certain whether other courts will eventually follow the Northern District of Florida court's lead, but until then, employers still need to consider this when they're determining how to implement the provisions of PPACA that may affect them. And with that, I'm going to turn it over to Kathy Aizawa to talk about the Form 5500 Schedule C reporting requirements.
Thanks a lot, Belinda. So first of all, what exactly is a Schedule C? Well, it's one of the schedules that's attached to the Form 5500 annual report, and the purpose is to report service provider fees and other compensation of $5,000 or more. So why are we talking about this? Well, the Department of Labor revised the requirements and greatly expanded the requirements for a Schedule C back in 2007. And the stated purpose was to help sponsors better fulfill their fiduciary duties to assure that plan expenses are reasonable for the services provided. They address the sophistication of the marketplace, and this is especially in the context of 401k plans. And it's also to help plan sponsors identify conflicts of interest among their providers. Who does it apply to? It applies to large pension and welfare benefit plans, and that means plans that cover more than 100 participants. And when is this effective? Well, it's really effective for the 2010 5500. So those are the forms that would be due for calendar year plans July 31st of 2011. As I mentioned, the regs were actually revised back in 2007, and they were effective for 2009. But given the sea change of how much information now has to be provided, last year the DOL gave employers a pass and said as long as your providers had made a good faith effort to revise their systems but were unable to provide the information on time, then the employer was excused from having to comply with these new requirements. So before we get started, I just want to go over sort of four basic definitions that will sort of help us understand these new requirements. First of all, what is reportable compensation? Well, that means any money or anything of value. So this would be gifts, awards, or trips that are received directly or indirectly from the plan because of services rendered to the plan. Direct compensation is like what it sounds like. It's fees that are paid for with plan assets. So examples would be if the sponsor actually pays the fee but then is immediately reimbursed by the plan, that would be direct compensation. And of course, any amounts that are directly deducted from participant accounts or also from a trust before the allocations are allocated to, or contributions are allocated to participants. Also then we get into the concept of what is an indirect compensation. And that means amounts paid to a provider from a source other than a plan trust if the payment is because of services rendered to the plan or because of a person's position with the plan. So an example would be a mutual fund who pays management fees to its investment advisor, or your record keeper attaches plan administration fees as part of its expenses, and that would be to help you complete the Form 5500 or just to provide basic record-keeping services, or different kinds of expenses like float revenue or brokerage commissions or 12B1 fees. Another concept is eligible indirect compensation, and this is a two-pronged definition. First of all, it has to be certain types of fees or expense reimbursements that directly reduce an investment's return, and for which that the provider issues a written disclosure to plan sponsors. So what type of revenue? Well, this is finder's fees, float revenue, brokerage commissions, and soft dollar revenue. And the written disclosure requirements are, first of all, the provider has to tell the plan sponsor that this indirect compensation exists, the services provided and the purpose of the payment of the compensation, an amount or the estimate of this compensation, and this can be satisfied by providing a formula to calculate the amount. For example, a certain number of basis points times the fund balance. Also, the identity of the parties paying and receiving compensation. Now, this written disclosure can be transmitted electronically, and while the final regulations don't provide a specific deadline by which this written disclosure has to be provided, just common sense tells you that the disclosure has to be done in time so that the employer can timely file the 5500. So why is eligible indirect compensation important? Well, it's important because if you have eligible indirect compensation, there's an alternative reporting option that's much simplified. And if you do have it, then it's just simply you can provide the name, the EIN, or the address of the providers who receive such compensation on the Schedule C, so that's much easier to do. Now, there are several examples of expenses that do not have to be reported on the Schedule C. So, for example, the commissions that are reported on a Schedule A are excluded. Also, a mutual fund's ordinary operating expenses. So, for example, a mutual fund's fees that it pays to its own attorneys, accountants, or printers, that's excluded. And also, of course, payments that are not paid from the plan's trust. So, example, if the sponsor actually pays for the invoice but isn't reimbursed by the plan trust, then that would not have to be reported. There's also this whole area of non-monetary compensation, and an easy example would be a service provider's promotional gifts that are of nominal value. For example, coffee cups or mugs that have the service provider's logo emblazoned on them. And but the final regs do point out that just by slapping a logo on something is not going to excuse you from having to report it if it's a significant gift. And they gave the example of a $400 golf club or a very expensive pen. That is going to have to be reported even though it is a promotional item. Also, holiday gifts that are based solely on personal relationships do not have to be reported. And to be excluded, the gift has to be tax deductible by the person providing it and not create any taxable income to the recipient. Also, single gifts have to be valued at less than $50. And there is a maximum annual limit of $100 from one provider. And if you actually do exceed this $100 limit, then the value of all the gifts over $10 have to be reported. So this also begs the question about, what about business meals and entertainment? Well, those kind of expenses do not have to be reported if they are not given because of the recipient's position with the plan or the amount of services provided to you or the business conducted with an ERISA plan. So, for example, if Foley and Lardner were to host a hospitality suite at an ERISA conference, and there were attendees at the conference who were clients and also non-clients. But if everyone was invited and welcome to come to the suite, then those expenses would not have to be reported. There's also this question of educational conferences, and they actually can generate reportable compensation. For example, a consulting firm sponsors an educational conference for its clients' human resources staff, and it provides it for free. This would be reportable indirect compensation because the conference is provided only due to the attendee's position with an ERISA plan. But keep in mind that conference overhead, for example, speaker's fees, is excluded. It does not have to be reported. There is a way, though, that you would not have to report the expenses generated from an educational conference, but it does require some pre-planning. And the exception applies if there's a plan fiduciary, somebody who did not attend the conference, actually states in writing in advance of the conference that, first of all, if the plan's trust were to pay for these expenses, that would be a prudent expense, that the payment of the expenses are consistent with the plan's written policy designed to prevent such abuse, and that assumes that such a written policy actually exists, that the conference reasonably is related to the attendee's duties, the expenses are reasonable in light of the benefits afforded, and the attendee's judgment about the consulting firm is not compromised because of this free benefit. Also, the question has arisen about how do you allocate indirect compensation if there are multiple plans? And there the Department of Labor gave us a break. They said you can use any reasonable method as long as the provider discloses that method to the plan sponsor. As I mentioned before, these new reporting requirements also apply to health and welfare plans, but there is a meaningful exception to this. Unfunded self-insured plans or fully insured plans or any combination thereof do not have to file. But plans funded through a trust such as Aviva are required to file. And so, of course, direct compensation examples would be a plan that pays its third-party administrator a fee for like each claim process. That would have to be reported. Also, pharmacy benefit managers or PBMs, they're also TPAs for prescription drug programs, and they do receive fees that are reportable compensation. So, for example, a direct compensation would be the fees that the PBM charges for dispensing a drug or also the administration of the plan. Oftentimes, too, PBMs can provide drugs at a much better price, and in part it's because of the rebates and the discounts that the PBMs receive from the drug companies. And currently, those rebates and discounts do not have to be reported on the Schedule C, but this is a question that the Department of Labor is considering, whether or not they should be reported. There's also a section on the Schedule C where sponsors are actually required to identify any provider who fails to provide the information to complete the Schedule C. And the Department of Labor cautions sponsors to use this judiciously, that they want the sponsor to actually make the request of the provider in writing and to tell them that if they fail to comply, that they are going to be identified on the Schedule C as being non-compliant. And the reason why the Department of Labor is sort of sticking to its guns on this point is that they said that this information will allow the department to better carry out its responsibilities and to administer and enforce Title I of ERISA. And as Galen will mention, it may very well be that non-compliant providers could be subject to an excise tax. So with that sort of teaser, I'm now going to turn it over to Chris Berry.
Thank you, Kathy. Good day. On October 22nd, 2010, the Department of Labor's Employee Benefit Securities Administration proposed changes that will broaden its regulatory definition of fiduciary under the Employee Retirement Income Security Act. These proposed changes will expand the circumstances under which a person is considered to be a fiduciary by giving investment advice to an employee benefit plan or a plan participant. The proposed changes will have important implications for ERISA plans, participants, and employers, as well as many plan service providers. Today, we'll cover the scope and nature of the proposed changes, as well as their potential consequences for those who sponsor, participate in, or provide services to ERISA plans. The public comment period on the proposed regulation expired on February 3rd. The nearly 200 comment letters received by the Department of Labor indicate how provocative the proposed changes are. In a few minutes, we will review some of the principal themes in those comment letters. The Department of Labor announced that it will hold a public hearing to discuss the proposed regulation on March 1st, with the possibility of extending the hearing to a second day on March 2nd. If and when the Department finalizes the proposed regulation, the current guidance from the Department is that the final regulation will become effective 180 days after its publication in the Federal Register. Next slide, please. In view of the potential expansion of who may be considered a planned fiduciary under ERISA, it is important for us to review briefly the consequences of being a fiduciary. To protect the interests of participants in employee benefit plans, ERISA establishes standards of conduct, responsibilities, and obligations for the fiduciaries of those plans. ERISA also imposes a number of duties on those who act as planned fiduciaries, including a duty of undivided loyalty, a duty of care, and a duty to act for the exclusive purpose of providing planned benefits and defraying reasonable expenses of administering the plan. ERISA supplements these duties by barring certain prohibited transactions between an employee benefit plan and the plan fiduciaries. Further, fiduciaries are personally liable under ERISA for losses sustained by a plan that result from a breach of any of these duties or a violation of any of these rules. Next slide. ERISA provides that a person is a fiduciary with respect to a plan to the extent the person exercises any discretionary authority or discretionary control with respect to the management of the plan, or exercises any authority or control with respect to the management or disposition of its assets, or the person renders investment advice for a fee or other compensation with respect to any monies or other property of the plan, or the person has any discretionary authority or discretionary responsibility in the administration of the plan. The proposed regulation relates to the second alternative in this statutory definition. On its face, the second section, which is highlighted in blue on this slide, sets out a simple two-part test for determining fiduciary status. Part 1, a person renders investment advice with respect to any monies or other property of the plan, or has any authority or responsibility to do so. And Part 2, the person receives a fee or other compensation, whether direct or indirect, for doing so. In 1975, shortly after ERISA was enacted, the Department of Labor issued a regulation that sets forth the circumstances under which a person renders investment advice to an employee benefit plan within the meaning of this statutory definition. Now, after 35 years, it is that regulatory definition that the Department of Labor proposes to change. The next series of slides compare the current and proposed regulatory definitions. The current regulation, which appears on the left-hand side of this chart, narrows the express language of the statutory definition by creating a 5-part test that must be satisfied for a person to be treated as a fiduciary by reason of rendering investment advice. To constitute investment advice, an advisor who does not have discretionary authority or control with respect to the purchase or sale of securities or other property for the plan must meet all of the 5 conditions on the left-hand side of this chart. 1, the advisor must render advice as to the value of the securities or other property, or make recommendations as to the advisability of investing in, purchasing, or selling securities or other property. 2, the advice must be provided on a regular basis. 3, the advice must be provided pursuant to a mutual agreement, arrangement, or understanding with the plan or plan fiduciary. Next. 4, the advice must serve as a primary basis for regular investment decisions with respect to plan assets. And finally, the advice must be individualized based on the particular needs of the plan. In a 1976 advisory opinion, the Department of Labor concluded that a valuation of closely held securities that an employee stock ownership plan would rely on in purchasing the securities would not constitute investment advice under the regulation. In 2005, in another advisory opinion, the Employee Benefits Security Administration suggested that a recommendation to take a distribution from an employer-sponsored plan does not constitute investment advice. As I mentioned earlier, the current regulation has not been revised since 1975. The Department of Labor now believes that in view of the intervening changes in retirement plans and the financial marketplace, it is appropriate to revise the investment advice definition to ensure that a person providing investment advice to a plan fiduciary or a plan participant will be subject to the ERISA standards of fiduciary conduct. Back to slide 36. The proposed regulation would replace the current 5-part test with a new 3-part test. The proposed 3-part test appears on the right-hand side of this chart. Part 1, the person must provide advice or make recommendations of the type described in the chart in sections 1, 2, next slide, or 3, all on the right-hand side of the chart. Secondly, as part of the 3-part test, the person directly or indirectly meets any of the conditions that are described in, let's go back to slide 38. Go back to 37. Parts 1 or 2, now go to slide 38. 38, please. 3 or 4. And then finally, as the third part of the 3-part test, slide 39, the person receives a fee or other compensation, direct or indirect, for providing such advice. So again, the 3 parts, the person must provide advice or recommendations of the type described under Part 1. They must meet one of the conditions described under Part 2, and they must provide investment advice as described under Part 3. When you compare the current proposed regulation side by side, you will initially note that the proposed regulation would incorporate many of the elements of the 5-part test of the current regulation. However, the proposed regulation would make several changes that would have the effect of including more who provide investment advice in the category of a fiduciary. First, under the proposed regulation, a fiduciary could include a person who provides advice to a plan participant or beneficiary, as well as a plan or plan fiduciary. This contrasts with the current regulation, which only covers someone who gives advice to a plan or plan fiduciary. Second, under Section 1 of Part 1, the proposal includes the provision of appraisals and fairness opinions, which, if finalized, would supersede the Department of Labor's 1976 advisory opinion that I mentioned earlier. Moreover, the definition is not limited to the appraisal of employer securities, but could extend, for example, to real estate appraisals. Third significant difference under the proposed regulation, it would no longer be necessary to prove that investment advice was provided on a regular basis. The department apparently doesn't believe that it's significant that advice is provided on a regular basis. Rather, it's sufficient that the advice can be rendered only once. Fourth change, under the current regulation, the advice must serve as a primary basis for plan investment decisions in order to establish fiduciary status. Under the proposal, it would be sufficient if the parties understand that the advice will just be considered in connection with making a decision relating to the plan assets. And the fifth significant change, under Section 3 of Part 1, the proposal would include the provision of advice regarding the management of securities or other property, which would include, for example, advice as to the exercise of rights with respect to stock, such as voting proxies. It would also include advice as to the selection of persons to manage plan investments. Slide 40, please. As of last Wednesday, the Department of Labor's website had posted 193 comment letters regarding the proposed regulation. The comments reflect the Goldilocks effect. Some commentators saying that the proposed regulation goes too far, some saying the proposed regulation does not go far enough, some commentators saying it's just right. Predictably, employee pension rights advocates came out strongly in favor of the proposed changes. However, comment letters submitted by employer representatives and industry groups urged the Department of Labor to consider some of the unintended and, in their view, undesirable consequences the proposed regulation could have on retirement plans and participants, as well as service providers. If the proposed regulation is finalized without expanding safe harbor provisions and exemptions. Several key Democrats in Congress think that the fiduciary advice under ERISA should be construed broadly, and they have cautioned the department to be specific and limited in the safe harbor language and exemptions for those who provide sales and marketing-related materials and investment education. In publishing the proposed regulation, the department specifically solicited comments as to whether and to what extent the final regulation should define the provision of investment advice to encompass recommendations relating to taking a plan distribution. Several commentators responded in the affirmative. They expressed concern about a potential for bias when an advisor to a participant recommends that the participant take a distribution and consider an investment in which the investment advisor has a financial interest. Next slide. In general, employer representatives and industry groups are expressing concern that the proposed regulation is so broad it will impose fiduciary status on a significant number of people and organizations whom Congress never intended to be ERISA fiduciaries. They predict that many service providers will have to restructure their current products and services and renegotiate contracts with existing customers to avoid becoming unwilling fiduciaries and engaging in prohibited transactions. Some of them also predict that the proposed changes may have undesirable consequences for retirement plans and plan sponsors in the form of higher service fees charged by these new fiduciaries who are taking on increasing risk. Further, ESOP industry groups are asking the Department of Labor to scale back the proposed definition of a plan fiduciary so as not to include the provision of stock valuations in what constitutes investment advice. In that regard, the AICPA has also noted a potential conflict between the proposed regulation and the unrelated Internal Revenue Code requirement for an independent appraisal of employer securities, believing that a valuation firm, which is a plan fiduciary, is not independent. In view of the number, breadth, and tenor of the comment letters to date, the next step in the regulatory process, the public hearing on March 1st, possibly extending to March 2nd, should be well attended and lively. We will keep you apprised of further developments. In view of the significance of the changes in the proposed regulation for plan sponsors, participants, and in particular plan service providers, we encourage you to keep abreast of these developments. Next up is Galen Mason in our Chicago office, who will discuss the new 401k fee disclosure regulation.
Thanks, Chris. I am going to go over, as Chris mentioned, both the plan service provider fee disclosures, those that the service providers give to the plan, as well as plan administrator disclosures to plan participants. These are two of the three DOL fee transparency initiatives that have come out over the past couple of years. The first being the one that Kathy described earlier regarding Form 5500 Schedule C. I'm going to go relatively quickly. We've got a very short amount of time here. So what I want to do first off is note a couple of things. One, you have all of our contact information. You'll certainly have mine at the end of the slides. And also note that for the most part, having seen the attendance list and matching most of our practices, I'm speaking from a plan sponsor or plan administrator perspective. So a first note, we're first going to talk about plan disclosures to participants. So what do plan administrators need to tell their participants about fees? There was a new regulation issued in October. It will become effective for any plan year after November 1st of 2011. So for most of you out there, that's going to be January 1st of 2012. And what that means is in order to meet some of the advanced disclosures that I'm going to describe to you, we'll need to do some information gathering and some work throughout this year, so most likely for open enrollment this coming December. The second category is service provider disclosures to the plan or to the plan administrator. And this largely puts teeth to the Schedule C information that Kathy was talking about earlier. It is the functioning law or the rules is the regulatory site you have on your screen, which actually amended an existing regulation. Those were issued in July of last year, originally to become effective for plan years beginning after July of this summer. However, these were recently extended to match the plan disclosure to participant timing, so we're also talking about a January 1st, 2012 compliance deadline. So service providers will be spending much of this year discussing and assembling what they need to get to plan administrators. One note that I have here just on fee litigation, I couldn't help but note when you start talking about DOL fee transparency initiatives that this is a sort of a separate track from a lot of the fee litigation that's been going on, which involves both excessive fees but also fee transparency, things like revenue sharing and the fact that participants may not have understood that much of the costs that their plan was paying they may have thought they were not paying, but indeed they were through some of the revenue sharing arrangements. So I don't know that I'm comfortable saying that those suits would not have been brought had these rules been in place many years ago, but it certainly would have been less likely. So that's just something to keep in mind, that that's a separate track that's out there. So the first category, disclosure to participants. Just wanted to go over here which plans, of course, does it apply to. We're talking about individual account plans in which participants have control over their investment. So we're generally talking about 401k and 403b plans. There is no, one thing to note is there is no small plan exception or small balance exception, unlike a lot of rules that we have for disclosure. This goes right down to the smallest of plans. The rule applies to the plan administrator, not necessarily all fiduciaries. So if you're a plan administrator, this is something that you're going to need to be thinking about this year. However, luckily, plan administrators can certainly rely on information that they receive from their service providers, and we'll talk about that as well in a minute. So what does this regulation do? It regulates both content and timing. So not only does it tell you what you have to tell people, it tells you when you have to tell them. And we're going to go through each of those components. I think we have the effective date of January 1, 2012 already covered. One thing just to note here is that the disclosures under this rule can be made pursuant to existing disclosure rules. So most of the time, generally, that's going to include electronic distribution, but the DOL in the regulation notes that it's open to discussing other methods or more elaborate electronic distribution compliance methods. So what needs to be disclosed? There's really two general categories. There's information about the plan, which breaks into 3 subcategories, and then there's information about the investments in the plan itself. And I'm going to talk about the first category, information on the plan, in those 3 subcategories. So the first category is general plan information. And this is where what I'll do here is I'll make up a little time when I get to some of these lists, because these are really detailed in the regs, and I don't want to end up reading you my slides, but general information is really just what it sounds like it is. It's the name of the investment options, when participants can make elections, things of that nature that are in the plan document that need to be disclosed to participants. The second subcategory is administrative expenses. And so these are expenses that the plan under ERISA may charge to an individual account, and those need to be disclosed. The fact that those can be disclosed, the fact that those can be charged to an individual's account, how much can be charged, and how it may be charged needs to also be disclosed to individuals. And another note here, I'm skipping ahead a little bit, but one of the things you need to do on this point for administrative expenses is you need to disclose the fact or the existence of revenue sharing arrangement, which may serve to reduce the administrative cost. One of the disclosure timing components, which we'll get at in a minute, involves quarterly updates disclosing actual costs, and that revenue sharing disclosure needs to be in that quarterly report, so that if participants see that if they get a notice and they note that while my administrative expenses are very low, that may not actually be the case if there's a revenue sharing arrangement in place. So that subcomponent there needs to show up in the quarterly report. Individual expenses, these are, again, just like the title implies, some action that the participant takes that may or may not generate an expense that can be taken from their account. So requesting a plan loan, quadros, investment advice, things of that nature, those need to be disclosed in this advanced disclosure, and that's the third subcategory of plan expenses. So this next slide is when to disclose this information. So the material we just went over, the advanced disclosure rule, is on or before the date a participant can direct his or her investments, and at least annually thereafter. So as we go back to the effective date of these rules, January 1, 2012, this information is going to need to be out before that date. So most of this is going to be information that we're putting together throughout the course of 2011. It's okay to include this information in the SPDs or benefit statements, but only if those documents are already meeting the schedules and the timing requirements in the regulation. Of course, the notices have to be distributed to all eligible employees, not just those that are participating in the plan. Two other timing components here. Anything as needed. If you've already disclosed information and something changes at a later date, there's a 30-day window to get that change out to participants. So not sooner than 90 days, but no later than 30 days before the change becomes effective. There's a reasonable exception to that window. So, for example, if for some reason you need to swap out an investment option or something very, very quickly, you're not going to be held over the fire for not meeting the deadline. Interestingly enough, there is apparently no materiality exception to the updating requirement. So the DOL is of the opinion that if you put something in the notice and it changes, then you need to meet the updating requirement, get that new information out to participants. Quarterly updates I mentioned earlier, those are required to go out quarterly, obviously, and disclose the actual administrative and individual expenses that are hitting individual accounts. So investment options. I talked first, the first component was plan information or expenses generated by the plan. Now what we need to talk about, the second component, is what information do you have to disclose to participants about the expenses that may or may not be buried in the investment options that they select. And there are a list of automatic disclosures, so these things need to go out whether a participant is participating in a product or not. They absolutely have to be in chart format, and the chart needs to display certain information such as the name of the plan, the date, and a statement that there's a website where they can go to get more information. Fortunately, the Department of Labor has put out a model chart, and we'll go over that. I have that embedded here on the slides. But they put out a model chart, the use of which will constitute compliance with the regulation. So investment options, and I'll go through these relatively quickly, but because we're also going to go through the chart here as well. But what do you have? So what do you have to disclose about the investment options? First, you have to obviously identify the investment product. Then you have to include product performance data, and that differs depending on whether you're talking about a fixed return product or a variable return or a product without a fixed return. And that is laid out in the chart. We'll see that in a minute. And it typically, so if you're talking about a variable return, it'll be a 1-year, 2-year, 3-year, 5-year. And there are specific rules on what you do, for example, if you have a new product. You have to, item 3 here, you have to disclose benchmarks so that individuals can compare how their investment is doing, either well or not well, relevant to a particular benchmark, and there are rules governing the selection of specific benchmarks. For example, the benchmark can't be one used and produced by the provider of the actual designated investment alternative. And then, of course, fee and expense information, and there are certain fees that you need to detail in there. Of note is that you need to include a $1,000 investment example, and you also need to include certain magic language detailing that plan fees and expenses can significantly impact performance over time. Item 5, you have to include a website for each designated investment alternative where they can get all manner of additional information, and what has to be included in each website. At that website is, again, detailed ad nauseum in the regs, but it's things like portfolio turnover, principal strategy, and more up-to-date actual performance information. Finally, a glossary of terms to help participants assist in the understanding of all of this investment mumbo-jumbo, and that you can include that in this advanced disclosure document, or you can simply reference a website that has that glossary attached. Finally, one thing to note, and it's somewhat beyond the scope of the extremely limited time we have here, but there are separate rules for annuity investment options and employer stock fund investment options. As you can imagine, those would both pose fee disclosure rules that will be somewhat different than a typical designated investment alternative. So a couple notes here. Plan administrators, you are always free to provide additional information. So the information in the chart, you're not limited to it. You can provide more just so long as you understand that you are subject to the standard fiduciary duties such that that information must be right. You have to believe it to be in the best interests of participants. So don't think you're limited by the chart. Second point of note is that designated investment alternative, the definition in the regulation, does not include brokerage windows. So, for example, if you have a brokerage window in your plan, it doesn't mean that all of a sudden you have to go and include every single theoretical investment option in your chart. However, you do need to include expense information in the, I believe it's the administrative expense section for the plan. Oh, I'm sorry, the individual expense section for the plan. So here, just I think it's helpful having kind of thrown all that at you. It's helpful just to kind of look visually at what exactly the model chart looks like. And this is a reproduction, as you can probably tell, from the regulation itself. And I've numbered these items just so I can relay them to you as we're talking over the phone. But one, for example, you see that we have the name of the plan and the date that these investment options are described. Two, we have performance information. Three, noting the website for each designated investment alternative. And four, we have the various benchmarks compared to the performance information. On the next page, I wanted to point out here, I think this is a very interesting component, but where the fees need to be broken out per $1,000 investment. So you see that in there as well under this fee and expense section. Item 6 just shows where we have the magic language, as I call it, describing for participants that fees and expenses can dramatically impact the performance of their investments over time. And then item 7 notes this unique annuity section. One of the things you see there that annuities that you need to describe for annuities that you may not need to describe for other investments is the restrictions or fees that may be associated with an annuity if you decide you want to get out of it. And lastly, item 8, this is the glossary in the model chart. The DOL clearly chose not to detail every glossary in term that they were using, but instead indicated that what they were doing was referencing a website that had that information. So investment information, what do you have to do? That's information that you need to give to participants before they invest. Once an individual invests, then there's certain disclosures that need to be made, as well as some that need to be made upon request. And these are pretty straightforward, but it's voting materials or governing documents involving the plan, involving the investment itself. So when to disclose the investment options? Really, these are the exact same rule as is for the plan information. It's likely going to come in a single form. So on or before the date, a participant can direct his or her investments and at least annually thereafter. And then if you have changes, you're subject to the same 90, 30-day window before a change becomes effective. So moving very, very quickly along here, I'm going to talk about service provider disclosures to plan sponsors. So this should come as something of a relief to those of you, to you plan administrators out there, because this really is getting at holding service providers' feet to the fire to get you information about how they're making their money, what possible conflicts of interest they have. But this is really designed to help you be armed with the right information you need to complete your fiduciary duty. Of course, there's no requirement that once you understand certain fees and compensation that service providers are being paid, you choose the one with the lowest cost. These really only get to getting you the information that you need. As I mentioned earlier, this is the rules here are in regulatory format, but this is an amendment to a regulation that already existed. Operation generally and design of the rule, and both Chris and Kathy touched on this on some of the components I'm going to go through here relatively quickly, but as you can imagine, when we're talking about information that service providers need to disclose to the plan administrator, a lot of that information, in addition to going into whether you're going to hire the service provider or not, or maybe ending up in some of the disclosures you're making to plan participants, is going into your Form 5500 Schedule C that Kathy talked about earlier. So Generally, the operation design of the rule that the DOL has set up here is that under ERISA 404, you're clearly a fiduciary subject to all of the fiduciary duties under ERISA. And absent an exception, one of the enumerated no-nos under ERISA, or prohibited transaction as we call them, would be for a fiduciary to allow the furnishing of goods or services or facilities between a plan and a party in interest. Well, that's exactly what we're doing when we hire service providers to perform services for the plan. So there is, of course, a statutory class exemption for that. It's 408, ERISA 408b2, which permits a reasonable contractor arrangement under ERISA. And this new regulation makes clear what compensation will indeed be considered reasonable. So next slide, Linda. The rule is generally applicable to defined contribution and defined benefit retirement plans, not SEPs, not simple retirement accounts or IRAs, and notably not welfare plans, although there is a reserve section in the regulation which indicates the DOL may have a mind to impose these rule on welfare plans, but they have not yet done that. That being said, using some of the guidance and the rules that you see in here to elicit information from your welfare plan service providers is probably a good habit to get into. It's applicable, the rules are applicable to service providers that enter into contracts or arrangements with plans in which they reasonably expect to receive $1,000 or more in direct or indirect compensation. As I mentioned earlier, these rules start to become effective January 1, 2012. So service providers should be gearing up to get you this information probably as we speak. So which service providers have to provide you this information? And I'll save a little time on this page. The first point I want to make is it's any service provider that meets the $1,000 requirement and then falls into one of three categories and becomes what's called a covered service provider. There doesn't have to be a written contract between the plan or the plan administrator and the service provider. So long as they meet the $1,000 requirement, they expect to provide services to the plan, then there doesn't need to be a written contract. However, the disclosures that the service provider does provide to the plan, those do need to be in writing, and we'll talk about those in a minute. So as I mentioned here, there's three categories of covered service provider. If you are a covered service provider or you're concerned about what your covered service provider is giving you, know that functionally the reason that there are three different categories is that certain categories may need to provide a particularly unique or additional information. So on the next slide, what do they have to disclose? So if you're a plan administrator, what are you looking for? What do they have to disclose to you? There's no particular format required. The DOL is considering a summary requirement as well as issuing a potential sample form, maybe like what we saw for the plan disclosure to participants. But as yet, there's nothing like that. It's likely, my guess is it'll be some sort of cover letter or report, and then the market will kind of determine what becomes standard. It may actually be, it can certainly be disclosed in multiple documents. So specific content of the initial disclosure, there of course has to be a description of the services, and you as a fiduciary, as a plan administrator, you're liable to determine the adequacy of that information, whether you think it's enough for you to meet your fiduciary duties. The service provider needs to disclose their status as a covered service provider. I mentioned there were those three categories of covered service providers. They need to indicate which category they fall into. There may be a little bit of controversy around this because one of those categories is whether or not you're an ERISA fiduciary, which, as many of you know, depending on the context, people don't always want to cop to. Description of the compensation and fees. This again mirrors a lot of what Kathy was talking about earlier. So it's money or anything of value that a service provider or its affiliates reasonably expect to receive in the next year, or financial products in which plan assets are invested. So that's both direct and indirect compensation, the distinction being direct compensation comes from the plan, and indirect compensation, the service provider, while they're providing services to the plan, will be getting paid from someone else. Direct compensation can be disclosed in any aggregate, or it can be disclosed service by service. As Kathy mentioned, it's okay to use formulas. However, for indirect compensation, the services do need to be detailed by amount and as well as the identification of the person who's paying those fees. Splitting, if there's arrangements where fees are split between the covered service provider and someone else, that needs to be disclosed to the plan administrator if it's based on some sort of transactional basis. So commissions, finder's fees, where maybe there's some sort of churning that you would need to know whether they're incented to take some particular act, or if it's charged directly against plan assets. So essentially meaning the fees are directly reducing the value of the asset as opposed to sending an invoice to the plan to be paid separately. Other disclosures that need to be sent to plan administrators are termination fees, any fees expected from termination, the method of payment, as I mentioned earlier, for splitting, whether it's billed directly against the plan or invoiced. There are special rules for record-keeping services, special rules for covered service providers that are fiduciaries, and special rules for covered service providers that are providing record-keeping services or brokerage services to individual account plans or essentially defined contribution type plans. And really, I think the quickest way to explain what these special rules are is what they're getting at is unbundling or showing plan administrators in an a la carte manner how fees are charged so that plan fiduciaries can compare apples to apples and not oranges to apples and any other thing else that's going on. So that essentially that revenue sharing can kind of be parsed out and compared. When does this information have to be disclosed? It's in advance of entering into, extending, or renewing a contract or arrangement with a plan. So there's no detailed time frame there, but it needs to be early enough that the fiduciary can still meet their obligations in terms of deciding whether or not to enter into this contract with the covered service provider. If you do become a covered service provider at a later point in time and you weren't expecting it, there's a 30-day window to get this information to the plan administrator. If your information changes, you need to get that information to the plan administrator within 60 days. Or if the plan administrator requests information in writing, you have 30 days to get that information. And if you find out that you made an error as a covered service provider, you have 30 days from the date you discover the error. Assuming you were diligent and acting in good faith, then you have 30 days to fix that. Okay, so very quickly here, as I mentioned earlier, whether or not you meet the requirements under this regulation dictates whether or not you and the plan administrator, their fiduciary, have entered into a prohibited transaction. However, as a plan administrator, fiduciary, you might not have control over whether you get this information. So what do you do if they don't give you the information or you request it and they refuse? The answer is what they send you, you can reasonably rely on that information under this regulation. However, if they fail to respond to your written request, then within 90 days or within 30 days of them refusing to do so, you need to notify the DOL. And that will protect the plan administrator fiduciary from being subject to the consequences of a prohibited transaction for having an unreasonable contract with a service provider. There's detailed material that needs to go into the notice to the DOL. I'm not going to go into that now. And one other point is you may not actually have to fire that covered service provider, but as a fiduciary, you do need to take into account the fact that they're not cooperating with you or not getting you the right information. Action steps, I think what I'll do, just because we're about 10 minutes over, I'll leave these. These are relatively self-explanatory, but just know that for both plan sponsors and service providers, there are a couple slides here describing what we think are the very, very high-level action steps to get started with your disclosure obligations that are going to be coming due at the end of December, but that are going to really require all sorts of conversations with a number of different people over the course of the year. And so just know that here is at least a starting point for you to get started doing that. And with that, I'll turn it back over to Kathy and apologize for taking up a little extra time.
Thanks. Excuse me. Thanks a lot, Galen. And I apologize that we did run a little bit over today's schedule, but we just had so much information to provide you. If you do think of a question, on the next slide is actually all of our contact information, and I encourage you to either give us a call or send us an email, and we can help you with any of your questions. Also, just to let you know, we do plan to provide one of these webinars every quarter, so if you wouldn't mind, these are the dates for this year's webinars. And then also just thank you very much for joining us. I understand that your time is precious. If you would like to provide or to print out a copy of the PowerPoint, you can do so today, or to get a recording of this presentation, you can find them at this website. Also, we really do welcome your feedback. We do take your comments into consideration. So you could just take a moment to fill out this quick survey, and also let us know what other kinds of topics you would like to have covered in future webinars. So thank you very much every day, and everybody have a terrific afternoon. Bye-bye.
Ladies and gentlemen, thank you for your participation in today's conference. This concludes the program, and you may now disconnect. Everyone have a great day.